Hi everybody, this is AJ speaking. This is part 11 of my Tesla 4Q 2024 financial review. This time we start with deferred revenue release guidance. So first of all, what is deferred revenue? Tesla takes in revenue for things that it cannot fully deliver yet, and for that reason it takes part of the revenue that it considers unsatisfied aside and puts it into a reserve. In terms of accounting, this creates a liability on Tesla's balance sheet. You can see this here on the right hand side table. Amongst Tesla's liabilities, there's a line item called deferred revenue. This is where this money sits. And what happens once Tesla satisfies these unsatisfied performance obligation, it releases that liability, and that then shows up as a deferred revenue release in Tesla's income statement, and that is a profit positive, obviously. And so that's sort of the big picture in terms of accounting, but the really important part here is obviously what is driving this. This is driving Tesla's FSD is driving this item to the largest degree. There are various other items included in that line item, but this is the main driver, and Tesla currently sits on roughly 3.5 billion of deferred revenue, and this amount will, at least to a significant share, will be released over time once FSD has reached sufficient majority. And in this context, it's always very interesting to look at Tesla's deferred revenue guidance, and what Tesla does every quarter. Tesla tells us how much deferred revenue they expect to release from that reserve, from the existing balance, and this is what this chart shows. So as of the latest quarter 4Q 2024, as of December 2024, Tesla expects over the next 12 months to release 840 million. This is a slight increase from the next 12 months from the September perspective. So this is always rolling forward, keep that in mind. There's a slight increase, and you can see that in September 2022, Tesla significantly took down its next 12 months deferred revenue guidance. I think Tesla realized that it would be harder to make FSD work, and that's why they became less optimistic and realized that they needed a lot more compute, etc., to make it work. And then later in 2023, Tesla switched to the neural net approach, and we see this in a minute. And after Tesla switched, then Tesla also started to outperform its guidance. So when we now look at the recognition, so keep in mind this was the expectation for the next 12 months as of each of these months. And then when you look at what actually happened over the next 12 months from the perspective of each of these months, keep in mind this is always forward-looking 12 months. And that's why this is not mislabeling or something here. 2024 is empty because we do not have the full next 12 months from the perspective of March 2024, because we will need June, September, and December plus March of 2025. So we don't have full next 4 quarters, hence we cannot show the next bar. So from after 1Q 2025 is reported, we can add the next bar. But what you can see is that Tesla reported from the perspective of December 2023 in the following 12 months almost 1.2 billion, and you can see here the change quarter on quarter is almost 26% sequential increase. So Tesla released significantly more. And when you look at the guidance in the same month, which 926 million, you can see there was a significant outperformance. And if we now illustrate the delta between these two numbers, the expectation and the actual delivery, this is what this chart shows you. You can see that in the most recently available quarter for which we can do this calculation, which is the fourth quarter of 2023, you can see that the outperformance versus guidance was actually 262 million. It's a new record. In the prior quarter, outperformance was 131 million, and you can see from 1Q 2023, Tesla started to outperform guidance, while in all prior quarters, Tesla never delivered on its guidance of deferred revenue release. And I think, it's obvious why, because FSD simply didn't develop as quickly as Tesla anticipated. And Elon talked about this ad nauseum, and he talked about this about a sequence of log curves. And if you don't know what a log curve is basically kind of an exponential curve upside down and turned 180 degrees. I'm not sure if this is helpful, but basically it's a curve that's growing very quickly in the beginning, but then is tapering off substantially and then barely makes a progress. And the reason why it talks about sequence of log curves, because you always need to then have a breakthrough to get to a new log curve. And he talked about local maxima, which means local maxima means that in this locality you cannot improve further, and that's why Tesla always had to sort of fudge around with different approaches, and it did make some improvement, 2 steps forwards, 1 step backwards, but FSD really got going once we moved to neural networks, and you can see this now in the numbers. Tesla started to outperform its guidance. And when you now look at these boxes, this greenish box shows you Tesla's guidance development, and then you see what was actually delivered. As I explained before, we cannot fill the boxes here for 2024 yet. And if we take the 2023 trend as a guide, you can see that we will likely outperform this 848 million guidance, and we will probably see a number significantly north of 1.2 billion, and this outperformance is bound to increase, which basically means Tesla is likely releasing more deferred revenue than they guided to. On this chart, you can see the development of the liability. I talked before, the deferred revenue liability, which is liability sounds negative, but in this case it's just money put aside, and once as you release a liability, it flows into the income statement, creates basically profit in Tesla's situation. And Tesla's, and I often call this the honeypot, is quite large. I'm sorry, before I said the wrong number. It's not 3.5 billion. It's almost 3.6 billion actually. But you can see it coming down, and the reason is coming down is that additions, numbers in green, started to be smaller than recognitions. This was always the opposite in the past. As you can see here, the ratio expresses the two numbers. When the ratio is smaller than 100, it means that additions were bigger than recognitions. But this flipped in 2Q, and in 2Q we saw for the first time ever that recognitions actually outpaced additions, and that's why you can see that the deferred revenue liability started to decrease sequentially from 2Q, from the all-time high of almost 3.7 billion to now just under 3.6 billion. And before we talk about operating cash flow, one more word on deferred revenue. As I said earlier, deferred revenue, there are two components. There is this deferred revenue release, but then also there are, let's call it one-off releases as Tesla releases features. So there are these two components to deferred revenue releases, and release of features has produced some significant margin boosts. And so this is an item shareholders should watch out for. When Tesla announces feature release in a quarter, you should take note, because that's margin enhancing, but it always obviously depends on the scale of such feature releases. For example, in 3Q, the FSD feature release that also included the FSD activation on all the Cybertrucks created a significant one-time effect and was a material driver of the bumper 3Q performance. So with that, I close this part 11. I will see you in part 12 when we dive into cash flow, which at the end of the day is really where the rubber hits the road.